Mutual funds are for people who want to own stocks but can't be bothered with the details. In a mutual fund, your only job is to send money, which gives you a certain number of shares in the fund. Your money is lumped together with a lot of other people's money and handed over to a fund manager who makes all the investments on your behalf. A mutual fund has another advantage besides having a manager who does all the work. It invests in many companies and asset classes at once. As soon as you sign up with the fund, you become a fractional owner of the hundreds of companies' stocks the fund already owns. Whether you invest $100 or $100 million, you still own a piece of all of the stocks in the fund. This is less risky than owning only one stock, which, if you are a novice investor, might be all you could typically afford. Most mutual fund companies require minimum investments ranging from $1,000 to $5,000, but the market contains several kinds of mutual funds, so this may not apply. Mutual funds trade once a day. Their share prices are based on its net asset value, NAV, and computed when markets close each day. The NAV equates the total value of portfolio assets minus any liabilities divided by the number of outstanding shares. Unlike stock, mutual fund shares do not give its holders any voting rights. A share of a mutual fund represents investments in many different stocks or other securities instead of just one holding. Investors typically earn a return from a mutual fund in two ways: selling their mutual fund shares for a profit on the market and getting paid a distribution from profits the fund itself gains. Those can be a portion of income the fund receives from dividends on stocks and interest on bonds held in the fund's portfolio. It could also include capital gains if the fund sells securities from its portfolio that have increased in value. A mutual fund's fees and performance will depend on whether it is actively or passively managed.